everyone. Good to see you again. Hope you enjoyed the networking opportunities while we were gone. Rick and I had a lot of fun talking to many of you in the virtual hall. But now we're going to get back to the program. And our first speaker here for this section is Frank Trotter. And Frank Trotter is Rick's partner in Battle Bank and is a very experienced financial industry professional, having founded Everbank some time ago. So let's invite Frank to the stage. And Rick, take it away.
Frank, first of all, welcome. Congratulations on a great live presentation or series of presentations that you did in Boca Raton. I think you did a great job there presenting the bank, and I hope we do as good a job today.
Well, we'll certainly give it a shot. We have Battle Mountain behind me to inspire us with the name.
I think we have really two things to talk about today. The first is what it's going to be like to be a customer of Battle Bank, either as a depositor or as a borrower, or hopefully both. What will the customer experience be like? The second is the fact that for accredited investors, Battle Bank is in the fundraising process, raising the equity necessary to hopefully replicate the amazing growth that you enjoyed in Everbank. So to begin with, perhaps you could talk about the unique customer experience that you hope to be able to show customers of Battle Bank as you so successfully did at Everbank.
Well, thanks, Rick. And I think, one of the keys there is, as opposed to, as we look across the banking landscape, it's sort of known to have predatory pricing and bad customer service. But what we've always done in a remote sense is hire the very best people, get them on the phones, get them on the chat, get them on the email, have it available online. And so you're talking to an experienced branch manager, perhaps, that's done this transaction that you're asking about 10,000 times. They're trying to train up from high school or college. We give the clients tools to do it themselves online, but we want to be there immediately and forcefully to provide assistance, guidance, ideas, whether that's in regular banking or in the global markets group where you're thinking about currencies, metals, or market index type of opportunities.
And perhaps you could talk about the fairly unique track record you have with regards to savings products, the simplicity of the products, and also the implicit pledge that you've made with regards to being in the top decile of deposit payers nationwide.
It sort of goes back to when we started Everbank. We looked at it across the landscape, and there were incredibly low rates, high fees, even in a relatively high interest rate market. At Battle Bank, we intend to be in that top decile of rates at all times. And instead of making you put a checking account, a savings account, a money market account, split all your money up, we're going to invite you to come in and take our money market deposit account. If you want to use it as a savings account, that's great. If you want to use it with full checking, debit, checks out the door, whatever you want to do, same value. And you sort of look at those high values. It's going to be in the upper ones, almost 2% in today's environment. Who knows when we open up the doors, but we'll be in that top decile of rates that are paid without tricks. There are a few banks out there that have some interesting algorithms that look like they're showing you a high rate, but you have to wear a green shirt on a Tuesday and a yellow tie on Wednesday and walk backwards into the Starbucks to get that rate. We're making it simple. We're pledging transparency. We're pledging easy to understand. And we're pledging low or no fees, both for the vast majority of clients.
Frank, I haven't shared this with you, but I have relationships with 3 of the multinational mega banks. And as I have shared with you before, they've maintained a relationship with me that I would describe as sullen, but not yet mutinous. Not the relationship that you want to have with a financial services intermediary. Yesterday, I went into my local branch of a very large American bank and found that the branch manager didn't know how to effect a wire from one of my accounts to a domestic service provider that I wanted to pay. It was simply astonishing. The same bank lost my trust documents 3 months ago, and I was responsible for replacing their lost items. Separate and apart from bitching, I guess what I want to hear is that based on your experience with Everbank, this isn't a situation that I would have to experience with Battle Bank.
Certainly would expect that would be close to zero. Andy said earlier that they'd had no complaints over 7 billion in transactions, and that's great. I think we would expect to have superlative reviews across the entire platform. We love to chat with our clients. If you want to talk to a particular person, just ask for it. It's not, some days perhaps Joe or Susie or whomever is going to be on the phone a little bit longer, but they'll call you back. This is a national community bank. Just happens to be geographically diverse community. It's a community of people that we all know and love, people who are here at the conference today, kind of that contrarian type of individual. And we want to build a relationship. And I'll tell you, we continue to get people joining our wait list today saying, oh, I was an Everbank client, or looking so forward to reestablishing a relationship with Battle Bank. I think we built that. We're going to build it again. We've got the team set up to do it. We already have the customer service lead people in place who know how to do it and had a huge following individually. We're going to know you, not going to lose your documents, and we're going to pay you great value and provide wonderful services.
Frank, it probably is worth saying that my intention is to own an eyelash south of 10% of the bank by the time it's functional. You've enjoyed 2 fairly successful fundraising sessions. For people who, in addition, would like to be depositors of yours or borrowers from you, or better yet, depositors and borrowers, but would also like to consider being owners, I understand that there are the opportunity for accredited investors to do just that now. Could you describe that, please, within the confines of the law?
Always within the confines of the law. Well, of course, banks have to raise capital, as you mentioned, at the lead in. And we do that both to support the operations as well as to capitalize the company. And a key element of it is we will be well capitalized. And I think that's unique among many banks. Today, if somebody who feels that they're accredited would like to invest to become an owner of Battle Bank, you can go to the battlebank.com website. There's an Invest in Us tab. You click that, and you can follow the directions down at the page. We're using a group called Invest Ready to certify accredited investors. And once you are certified, we'll send you the documents that allow you to consider making an investment in Battle Financial, who's the holding company for Battle Bank. We're looking forward to a broad array of folks, because not only would they be then shareholders, but likely be advocates and depositors. And we think this is a unique opportunity both to join almost a community of people who think like we do, but also to benefit as Battle continues forward.
I would note with regards to the offering that the step up, the differential in price between the price being paid by new investors and the price that was paid by people who organize and operate the bank is extremely low relative to other forms of business organizations. So you might mention, the pricing levels that, as an example, you and I participated in on the first round, the friends and families round, and the low valuation step-ups relative to the progress that's been achieved by your team in the short term that you've been around.
Well, exactly, Rick. You and I almost exactly a year ago put money into the company at $500 a share. The first round over the winter was that exact same $500 a share. And it was a very successful round. It was almost 50% oversubscribed. This round, for the investors that can come in through battlebank.com, clicked on Invest in Us, is at $550. That's a 10% step up. But we've also substantially de-risked the transaction from a great idea a year ago to where we have regulatory applications filed, we have technology contracts signed and in progress, and we have a great team that's starting to put the institution together. So it's a very nominal step up, particularly in regards to many of the other things people have seen through the years.
And can you tell us something, understanding that it's the answer is flexible, something about the timeline, how far we have to go before you believe that we'll have our charter and be up and running?
I think a good target is end of the year. There's regulatory, which we can't predict in any sense, although the conversations are going extremely well. Technology, we may have employees on the platform towards the end of the year, and hopefully be open for the public in the January range. Obviously, things are possible that they can move, but we're very optimistic and everything's moving along quickly.
Frank, sorry, I have to break in here. It's time to move to the next talk, but I did notice some questions coming in for you in the Q&A tab. So as you go back to the ready room, if you could just look at the tab, the Q&A tab, perhaps answer some of these questions, getting questions about international accounts and digital asset interface. So please go there if you can and answer the questions as they come in.
I'll look forward to that. And thank you very much.
Thank you. Thank you, Frank.
Thank you, Frank.
So always enjoy Frank's presentations. And one thing that he did very well and taught me early on when I first started with you at Sprott was I saw him build this next generation online banking interface.
Right.
At the same time, I saw him represent at the Sprott Symposium like an old-fashioned small banker, shaking hands, asking personal questions and whatnot. And it's something that I really was impressed with and tried to do here, even though we are, moving into this technological realm, to still kind of try to maintain that contact with our clients.
Frank and Vincent D'Amato are a unique combination of traditional banking, which is to say, know your customer, serve your customer, and modern technology. That was the success of Everbank, which of course went from 0 to $28 billion, a success that I believe he's going to be able to emulate.
That's very encouraging. Our next speaker, or our next guest is Louis-Pierre Gignac. And I apologize for my pronunciation. French class did not rub off on me. But again, another popular speaker at the conference. Their booth was very busy, lots of questions coming in for them. So let's invite him on the stage, Rick, and we'll get this conversation going between you and Pierre. As we wait for him to come on, though, just tell me a little bit about his company.
Well, what attracts me about Louis-Pierre Gignac and G Mining is the fact that the Gignac family has been known to me in the mining business literally for decades. They have built public companies in the past, but in addition, as contractors, they have built mines for other people, in particular, my close friends, the Lundin family. The Lundins are very, very accomplished customers. And the fact that the Lundin publicly gave the Gignac family very high marks as a contracting company led me to be very attracted. Louis-Pierre, welcome to the conference. You can both see and hear me.
Yes, I can.
I need to tell the attendees that the discussion that you are having today should be taken in the context of the recorded sessions that you did at the live conference. Your excellent general session performance, the recorded conversation that you and I did, the CEO interview, and of course your wonderful workshop. I want to begin by asking you to describe briefly what the value proposition is. What's the task at hand? What is G Mining doing right now? And how is what they're doing right now going to key their future growth?
Yeah, I'd say, obviously what we've done is created a company less than 2 years ago on the basis of a management team. And we went looking for projects and we acquired the Tocantinzinho project essentially about a year ago. In that time frame, we were able to update a feasibility study, and as of essentially 3 weeks ago, put our full financing package together to build this asset. So I'd say from a value perspective, we're fast tracking our way towards with a view of getting this into commercial production in the second half of 2024.
And
So,
my understanding from discussions with you is that having put one project to bed, you are confident and believe that having put one project to bed, you'll be able to grow the company in sequential fashion by repeating the process. Is that accurate?
yeah, correct. I mean, look, we see G Mining Ventures as being a platform to be an intermediate producer in the medium term. So our objective is to put TZ into operation and be looking for additional assets that we can either build or assets that we can optimize into our portfolio. So definitely we are looking to grow this company over time. And I think, you know, our recent investors with the addition of La Mancha into our register is an indication of that they see us as a platform for growth as well.
So the task at hand, as I understand it, is to build a rather large gold mine in tropical terrain, specifically high rainfall tropical terrain. Is there something about the history of the Gignac family that leads me to believe that you have the sufficient expertise to do this? I'm asking a rhetorical question, of course, and perhaps you could describe that prior success.
Yeah, absolutely. I'd say you know, we've had a lot of experience in South America, in particular the Guyana Shield. So having built the Marion mine in Suriname, and most recently the Fruta del Norte mine for Lundin Gold. Those are two operations that are in a very high rainfall environment. So it's something that we've been able to deal with successfully, and we obviously will be doing the same here with Tocantins in Brazil.
One of the principal risks that I encounter as an investor is access to financing. Building a brand new mine in Brazil requires a lot of money. The announcement of a successful financing, of course, de-risks that process. Can you describe the de-risking that's occurred as a result of your recently announced financing?
Yeah, absolutely. I'd say, you know, our objective with the financing package was to have full funds to construct. We were trying to avoid doing it piecemeal, you know, and eventually being fully financed. So that's what we were able to do. It required several moving parts to have the full financing package announced all at once. So that's what we were able to do, and obviously that de-risks us going forward. And you know, on top of that, we were able to build in essentially a $43 million cash buffer in as part of that financing as well.
Meaning that for the foreseeable future, until the commencement of free cash from this operation, you were in effect fully financed. Is that accurate?
Yeah, correct. We're fully financed until we're in commercial production. So I think that obviously puts us in a very good situation. Very few companies are in that situation that are looking to build mines right now.
And can you summarize the sort of high points of that financing? I thought it was very unique. I thought that you were able to do a really good job of securing adequate capitalization in an innovative fashion while limiting dilution to current shareholders.
Yeah, absolutely. That was one of our objectives from the get-go. So when you look at our financing package, we have essentially $353 million coming from Franco-Nevada, $250 million of which is going to be a gold stream. On top of that, they're providing a $75 million term loan and contributed to the equity as well, showing alignment with our other shareholders. So this resulted in a very low cost of capital when you put that all together, and allowed us to minimize the dilution at the equity level.
Let's go a little more deeply into that. The stream arrangement with Franco-Nevada traded off a relatively small percentage of mine revenues for a relatively large amount of the front-end capex. Could you quantify that for us? Yeah,
so when you look at the total capex funding requirement of say, you know, $457 million, $250 million, which is the stream, so you know, just over half of it. That's really taking off about 10% of the cash flow from the project. When you look at you know, the fact that they will be providing an additional payment of 20% of spot for every ounce we deliver. So yeah, we felt that that was a great valuation for us in terms of financing, and still leaves a lot of upside and leverage to the shareholders.
One of the things that I like to see as an investor is very smart long-term shareholders. So perhaps you could talk about who some of the investors in G Mining are, perhaps with special attention to Franco-Nevada, La Mancha, and El Dorado.
Yeah, so as you know, we acquired the project from El Dorado, and through that initial acquisition, they were very interested in keeping a large equity interest in the company, believing that we would do really well with the asset. So they maintained 19% at the initial stage, and as part of this last financing, essentially gave us back the 20 million cash that was part of our initial acquisition. So that puts them at about just under 18%. With the private placement, we have La Mancha that came in with a very large interest, taking 25% of the equity on a pro forma basis. And like we mentioned,
for those people who are less familiar with the mining business, perhaps you could explain the significance of who La Mancha is and what they've done as strategic investors before.
Yeah, so La Mancha is essentially a private investment vehicle that usually takes large equity stakes in mining companies, wanting board representation, and with a view of growing these companies over time. And when you look at their track record, they've done that successfully with Endeavor and Evolution. So they do have a very good track record of investing early with large investments and growing these businesses over time.
And how much of an interest does the Gignac family have in this venture? Are you guys, are you hired guns, or are you my partners?
Yeah, we're large shareholders. So we're essentially 8% shareholders. We've invested all along through the financings. We never received a share on a free basis. So we bought every single share that we own. So we see ourselves as shareholders before management in that respect.
Finally, actually two questions. It would appear to me that given the fact that you're fully financed, if someone would like to become a shareholder of yours, either an institutional participant or a high net worth retail participant, that they're going to be confined to the secondary market, that there won't be financing opportunities available in the near future unless you are unexpectedly successful at doing some sort of M&A transaction while you're building up Tocantinho. Is that accurate?
Yeah, that's correct. I mean, we're not going to be doing any equity issuances in the very near term, given that we're fully financed. So really, the buying on the market is the best way to become a shareholder at this point. Obviously, if we do grow the business, we would expect that to be in the medium term. So new fresh equity into the business won't be for a little while now.
And the final question is, I always encourage my attendees to outcompete other investors. You outperform them by outcompeting them, and you outcompete them by knowing more about what you invest in and who you invest in. So I'd like you to talk to our attendees about access to information around G Mining, about the parts of your website that are informative, about how you can access through the website the regulatory filings, and particularly about how you access living, breathing human beings within G Mining who can provide nuance and context around the regulatory filings.
Yeah, definitely. You can reach out through our website. Our investor relations department can get you in contact with other members of management as well to answer questions. But also, we're trying to be more active on social media platforms, showing advancements on the project, and also introducing investors to some of our management team that are actually boots on the ground building this mine.
Ladies and gentlemen, I can't emphasize this enough. If you're going to outcompete other investors, you need access to living, breathing human beings who you like and trust on the management team, so that you can take press releases and filing statements and you can understand the nuance that can't necessarily be included in a written document. Albert?
Yeah, thank you. We got to move on. Louis, thank you for joining us. Thank you for coming to Boca Raton. We had a great time with you. We really enjoyed your presentations.
Thank you very much. It was a great event, and happy to have been one of the participants.
All right, thank you very much. We're waiting for Peter Groskopf to join us next, but I want to emphasize the point that you've made many times, and that is, if you had just worked with the people in your career that rewarded you early, that you would have worked half as much and made much more money. And so I think it's important with Louis-Pierre to note just the experience, right, that he's had with giants in the industry and how he performed for them, and why that is a big indication of future success. Not a guarantee, but a very big indication.
Absolutely. I became aware of the Gignac family 40 years ago through my own relationship with Ned Goodman, who was a mentor of mine, and also through the recommendation of Seymour Schulich and Pierre Lassonde, who founded Franco-Nevada. This very much goes to the fact that in addition to knowing how to make money, you have to know who to make money with. This is my second generation of Gignacs.
Right.
And in fact, they were referred into me this time through by the Lundin family, who's made me an awful lot of money going back, who were satisfied customers when the Gignac family built their large-scale gold mine in tropical terrain. In other words, they aren't just successful, they're successful at the task at hand, which is critical.
Right. So as we wait, let's try to get Peter Groskopf here. I'm interested in hearing from him about developments at the Gold Council. Peter, welcome. We missed you in Boca Raton, but so glad you could join us here on this platform. How are you, Peter?
I'm great. Thanks for having me, and sorry to have missed the event. I heard it was great.
It was a lot of fun, but let's get down to business. Rick, take it away.
Okay.
There's going to be two lines of discussion here, Peter. One, a broad discussion of the value proposition for shareholders and for investors in Sprott,
Sure.
where you are the immediate past CEO and still a very large shareholder and still an important contributor. And then I want to move on to something that's going to fascinate our attendees, which is to say the interaction between yourself and Sprott with the new investor products at the World Gold Council. But let's begin with the sort of value proposition first for shareholders that you tried to create at Sprott. What is it about Sprott that should appeal to investors, given that it's traded both on the Toronto Stock Exchange and the New York Stock Exchange? Why own Sprott?
Well, in a very succinct fashion, it can be summarized as a royalty on the resource sector and the mining sector. Sprott is a globally recognized brand name. It has products across the spectrum, from physical, very liquid, daily liquidity type products to privately placed large-scale PE style funds, and it earns management fees from those funds. It operates at a very high margin, and it is levered to both the performance of its funds and gold and silver, and also to the actual price of the gold and silver itself. So it acts like a royalty, and it delivers that royalty-like cash flow to investors, pays it out in the form of a dividend, has room to grow that dividend over time. So it's kind of like a one-shot snapshot, over the sector.
Moving on briefly, Sprott manages in excess of $20 billion now on behalf of several 100,000 investors. In terms of experiencing Sprott as a customer, what would you say are the high point products from your point of view?
Well, first of all, we built the brand and the people and the collective DNA to deliver quality products and trust to investors in a sector that's otherwise volatile and difficult to sort within. So we deliver what we think is best of class content and compliance to those investors. And I would say, in terms of the products, on exchange traded physical products, equity funds, which are managed by professionals, and I would encourage anyone, especially at the exploration and development end of the sector, to have their funds managed professionally. And then for institutions, we manage longer term funds that are mostly geared towards the structured or debt side of the financing equation in the mining sector.
Your background, Peter, has been as an unusually successful investment banker, mostly in natural resources, having built a couple previous Canadian investment banks. You now are focused with regards to Sprott's efforts on behalf of issuers, the capital markets group. Perhaps you could describe both for our exhibitors, but also for our attendees, and for other issuers, what it is that Sprott offers capital markets participants.
Well, for individual investors, it provides access to all of our products. For institutional investors and accredited investors, it supplies situationally specific opportunities on placements and those that we find attractive. For issuers, what we do is we provide capital raising services across the board, retail and institutional. And what we're really trying to do there is help companies that are otherwise a bit difficult to cover. You know, it's hard for a company the size of, say, Merrill Lynch or Morgan Stanley to cover a small growing mining company. But what we can do is focus on it, bring larger equity syndicates to the table, help them finance their plans, and also provide them with some strategic advice if they're looking at acquisitions or specific transactions to grow their company. And we have a crackerjack team that does that out of Toronto and London. They cover the globe. They provide research on select number of opportunities, and I think they're amongst the best guys I've ever worked with in the business, guys and girls.
Peter, since you and I have been partners, which goes back to 2011, you've been almost messianic in your quest to make gold money again through technology. You've invested several millions of dollars on behalf of Sprott, also on behalf of me, in the process. And more lately, you've been very active in the same process through the World Gold Council. If you could describe what it is that you've been trying to accomplish, what accomplishments have occurred so far, and what our attendees can look forward to in terms of the utilization of technology to make gold functional money again.
Yeah, I'm glad you asked, Rick, and I think it's incredibly important. So I, along with other members of the World Gold Council, believe that gold can become money and will become money, and thereby defeat the number one criticism that it's had. And what's going on now is nothing short of transformational. It's very similar to the point at which gold was first introduced to investors through ETFs. The project is called Gold 247. I think it's the most important, change to occur to gold in a long time. And what it basically focuses on is allowing gold to become fully accessible and fungible on a 24/7 basis to all households. And I say that word carefully, all households at all times. So it's the tokenization of gold. The team at the World Gold Council, led by David Tate, and David is a consummate professional. He completely gets it. Randy Smallwood is the chair of the council, and everybody's behind this effort. I think they've done great work and are about to unveil the infrastructure and the effort itself in terms of how it's going to work. So I think people need to pay attention to it now.
And when you say it, what is it? Is it a digital token? Is it a coin? What is the product?
I think what it'll turn out being is a blockchain powered ledger which supports a principal token, which is allowed to trade globally and on a 24/7 basis. I think from there, the system can be offered through distribution channels that are much more accessible by the average investor, to put it in the hands of investors, and also to serve as a method of payment, which gold has never been allowed or capable of doing in the past.
This means really with low friction cost.
Yes.
That gold becomes a store of value. In other words, you can save in it, but it also becomes a medium of exchange. Is that an accurate summation?
It is. and it could never really be used as a medium of exchange before, and it certainly wasn't frictionless. ETFs considerably broke the barriers down, but I think what's happening now is a quantum further.
The idea that people could have come to our investment conference in Boca Raton, gone to the bar and bought a round of drinks for the table with a gold coin and received change in gold, I think is absolutely revolutionary and transformative. And what you're trying to do is affect just exactly that. Is that correct?
It is. I mean, I happen to have on my desk here, and I wasn't prepared for this, but I have this card, a Glint card, which allows gold to be held in your account and spent. And Glint has the technology and the payment system perfected. The last part of that puzzle is actually having your gold account not need to go through US dollars. And I think that's possibly on the table for the near future. But in any case, with a gold token available to be traded 24/7 and held in, any number of accounts, not just regulated investment accounts, I think it's going to provide a whole new level of exchangeability to gold.
And without expecting you to be too clairvoyant, do you have a sense of when our attendees might be able to learn more about this in the first instance? And then secondly, when this might be functional? In other words, when my attendees might be able to come to a future investment symposium and buy a round of drinks with gold and get change.
Well,
or more importantly, perhaps, pay their tuition fees in gold and receive change in gold.
Yeah, I think they can do that now. It is functioning now. There are gold tokens that are legitimate and can be purchased 24/7, such as PAX-G, that are open for distribution all across the US. And the Glint card does work for anyone that can apply for sign the application process. But I think it's going to get one step more efficient going forward. And you'll have World Gold Council behind some of those products.
I don't really want to put you on the table, or perhaps I'm putting myself on spotlight as a Sprott director. Is it conceivable that Sprott could pay dividends that were denominated in gold and go to
Yes.
owners' accounts?
Yes, that technology is also there. It's a bit clunky. I think it'll be perfected in the next year.
Wonderful. So at the Natural Resources Investment Symposium next year, we can have you back and you can say step by step, do this, and do this to make gold money.
Yes,
Is that sort of an accurate dream?
it is.
Great. In the little time we have left before Albert cuts us off, I want you to talk a little bit more about the value proposition, returning to Sprott, that we as Sprott, or you as Sprott, can offer to public issuers. I've spent a lot of my time explaining the benefit to customers of Sprott, but I want you to talk in the time we have left about the value proposition that you might offer up as an example to our exhibitors or to other public and private natural resource companies worldwide.
We start with the theme. We've always been on precious metals. Now Rick, we've daylighted as uranium investors in the past and coal investors, but we start with the macro. Right now, we're doing a lot of work on graphite, a lot of work on vanadium, some new things. Personally, I think silver is a great theme to focus on. And we look at where the opportunities are. So we drill down, find the quality deposits that major companies may want to buy in the future, those that are trading at deep discounts to what they could be worth if they were put into production. And to the issuers of those and the owners of those deposits, we provide advice on how to best raise capital, achieve the widest possible and the best possible investor support, and then also to put strategy together if they want to go buy an adjacent deposit, following industrial logic. Is what's going to be required for your company to optimize its value. So we provide the capital raising service, the strategic advice, and hopefully create broader syndicates, more market support, and frankly, graduate them to the Merrill Lynch's and Morgan Stanleys of the world, where as a multi-billion-dollar company, they'll get highly efficient service.
I would argue that today, the platform that you've been instrumental in creating over the last 11 years offers issuers the ability to access the largest institutional accounts in the world, while at the same time accessing the several 100,000 retail investors that populate the Sprott universe, which means that for a platform of your size, you're able to really offer a soup to nuts equity solution, both in terms of financing, but also in terms of aftermarket. And I would argue too, please disabuse me if I'm wrong, that Sprott has the ability internally, without syndication, to offer debt, to offer streaming for a different part of the financing stack, and of course to offer equity. First of all, am I telling the truth? And second of all, what, if anything, have I left out?
Yeah, no, I think you've described it very well. We're really unique in that we cover the investor base all the way from the largest institutions to dedicated retail investors that want to keep adding to their positions and trading their positions in the sector. And we provide every part of the capital stack as a potential service to companies that are building projects. So all the way from equity private placements, marketed offerings, to highly negotiated debt and streaming transactions.
Got a question for both of you. As gold sort of creeps forward into the digital realm, tokenized and whatnot, when companies start dividending out gold, it just takes another step closer to regaining its foothold on being the world's money. And I'm wondering, Peter, have you seen any pushback or any people kind of politically motivated to not let something like this happen?
Yeah, of course. The global financial system, which is really anchored by central banks and their agents, the commercial banks, are reluctant to allow others to supply efficient forms of money. And we have had a real reluctance by those parties to embrace gold, becoming a fungible, tokenized exhibit of a person's wealth and money. And we've been fighting some headwinds, but I think we're very close. Again, thanks to David Tate's good work, we're very close to being there.
Rick, what are your thoughts?
Well, I would say that, of course, you challenge the existing ecosystem, both in terms of their self-interest, but also in terms of their regulatory capabilities. They aren't set up as regulators to regulate gold as well. It's, from my point of view, heartening and useful to acknowledge the role of the Royal Canadian Mint in the existing Sprott products, and the fact that the Royal Canadian Mint has allowed Sprott, through the Sprott Gold and Silver Trusts, to go as far as they've gone in terms of democratization of gold as money. And my belief is that the World Gold Council will be able to interact with government authorities to at least make it possible, whether or not they're friendly. And I think, Peter, you foresee probably a role as steward for the Royal Canadian Mint or some sort of sovereign involved in securing the token. Is that accurate?
Yeah, I think there'll be an international network of qualified vaults and mints that will support the system. So there won't be so much of a need to move bars and kilo bars of gold around the world, be reminted and re-refined and moved from the LBMA storage to the COMEX storage based on shortfalls in each system. So I think we're going to move past all of that.
Guys, not to be negative, as I sometimes am, but where I see this going, if we're not careful, is that we birth this great system, gold enters the digital realm. You start with 100% reserve backed gold tokens, and then there is some pressure to go fractional on that. And the minute it goes fractional, we're back in the same situation we're in now. Peter, Rick, either of you want to comment on that?
Yeah, easy answer. The World Gold Council, its members, Sprott, and myself personally are united in one concept, which is we will never, tell people that something's not physically reserved when it's fractional. And I would encourage everybody that I talk to own physically backed 100% gold, tokens or otherwise, as opposed to fractional gold. What's the very purpose you hold gold? It's to get out of a fractional reserve-based system. I just think you need to stay there and you need to keep it there. So yes, there may be frauds, there may be copycats, but they won't be supported by me or anyone that is representing the World Gold Council interests.
I guess reputation again matters, right, Rick?
Well, the point of all this, as you learn in any sort of Austrian economics primer, is that good money drives bad money out of circulation. To the extent that this effort broadens ownership interest in gold, and to the extent that fraudulent competitors begin to appear, I don't think that there will be any problem for our attendees, educated attendees, to differentiate in movie parlance between the good, the bad, and the ugly. And what's important here is that the good will exist. The good doesn't exist today.
I guess that's a good point. So even you're referring to Gresham's. What would happen is, I guess, these gold tokens would be hoarded and not traded, right? That's exactly what happened with silver in the past when coins were minted in silver. The good money disappears,
right?
And the bad money circulates because everyone's going to get rid of it. If that happens, it's still valuable, though. Like you said, you have an option for 100% reserved money that you can store and you can trade if you wish to.
Which is markedly better than what we have today.
It is.
Gold becomes a medium of exchange that's simultaneously a store of value, but importantly is frictionless.
Yeah.
Let's not forget that gold trades over 100 billion a day, so it doesn't need a large percentage to become quite liquid. And hopefully people will trade it, use it, remit it, and hoard it.
The greatest innovation, of course, is that they'll be able to use gold to purchase their attendance at the Natural Resources Investment Symposium next year. I look forward to that.
Okay.
Peter, we got to move on, but thank you for joining us. Missed you in Florida. Next time we got to get you there in person, but thanks for coming on with us now.
See you soon, gents.
All right. Nice of him to drop in.
Wonderful.
Yeah.
Wonderful.
So we've got Danielle DiMartino Booth in the green room here.
Okay.
She did a great talk, and I really enjoyed moderating that panel with her on inflation, of course, a hot topic of today. So let's see if we can get Danielle into the room. Looks like she's coming in. Hey there, Danielle. How are you?
How are you? Happy Friday.
Happy Friday. Are you doing well?
Yes, indeed. I'm off the road. I'm finished traveling, which took some time to get here with all the cancellations. So yes, having a good day.
Right, that's always a problem. I got out unscathed, Rick, out of Boca. I got out as quick as I can before some hurricane can come and ruin things for me.
Well, as I suspect all of us could express, enjoyed getting together physically after all those years of public health challenges. It was lovely to be able to watch as well as hear the speakers. It was also lovely to be able to break bread or break bourbon or break whatever we broke in Boca Raton. This is also nice, being able to operate in the comfort of our own homes and stuff like that. But let's get rid of the self-congratulatory stuff and get to work. Daniela, what do you see? What do you think the key part of your message at Boca Raton was for the new attendees? What are people going to be able to look to and for with regards to the Fed, with regards to inflation? take it away. We've got lots of questions, but let's give us a foundation.
So I think what too few people are appreciating right now is that I think the Fed's going to go further than what the market is celebrating. It's hard for me to maintain my credibility and make such a statement because I've always been so critical of the Fed. But I sense I sense resolve in Jay Powell, and it remains to be seen. But he's doing a very, very good job of corralling the troops and holding the line. I mean, for you to hear somebody like Neil Kashkari or Charlie Evans come out and say, gee, 75 basis points could be what happens in September, the most dovish members of the Federal Open Market Committee. For you to hear them say, we're going to keep going, it's obvious that Powell is anticipating and understanding that even though we have seen peak inflation, which appears likely, it's certainly not going to come down to the Fed's 2% target anytime soon. And that's my baseline right now that I'm telling everybody is don't get too comfortable with this idea of the Fed riding to the rescue, and really don't get too comfortable with risky assets doing what they are. The looser financial conditions, the more the stock market rises, the more ammunition that the Fed has to keep tightening.
Changing subjects a little bit, Daniela, you existed for a lot of your professional career in the belly of the beast, in the Fed. Very recently, in the organization of Battle Bank, I've had the opportunity to deal directly with some of the employees of the Fed. I need to say that while there are certain aspects of the institution that, let's just say, I'm not fond of, I was amazed by the high quality of the employees that I dealt with. Is that something that, as a former inmate, if that's the right phrase, that is consistent through the organization? Is the quality of human being that I experienced as a bank applicant the extraordinarily high quality that I found as individuals? Do you feel that's ubiquitous across the institution?
I would have to say that I can only speak from the experience that I had. So when I was first at the Fed, I was in the research organization, which is the body of nearly 800 PhDs in economics. And I found that to be sclerotic and not very thoughtful, not productive at all, and not open-minded area of the organization. Now, Richard Fisher knew at the time that I was not doing well in research because they kept trying to stifle my work, and that's as much as I can. That's as much as I can put it in a synopsis. So he picked me up and he moved me to banking supervision and regulation, this little outpost that was there, and I was able to do my job. And I worked with some really fine individuals in banking supervision and regulation, and I suspect that you're working with that same area of the Federal Reserve right now.
I'm not smart enough to tell you which component of the belly of the beast that I inhabit, but I have to say that I had anticipated my interviews with the same enthusiasm that I might anticipate root canal. And I came out of it amazed at the interest that was shown, the sophistication that was shown, and the helpfulness. I think attendees need to know, while there are some aspects of the Fed that is pernicious, the part of it, at least that I've experienced with regard to regulation, has been surprisingly even-handed. And I hope that after you got released, I can't imagine anything more boring than a group of 800 economists personally, so I can understand how that was challenging. But I'm glad that at least you found in regulation that was consistent.
Rick, if I could just add one word on that. People ask me all the time, why don't you advocate for ending the Fed, Danielle? And I'm like, well, look, the Fed has a purpose. I think it does a really bad job of research and bad job of making policy. But I always say to people, look at what the Chinese government has been able to do in terms of infiltrating our intellectual property and stealing it. How would you like for our banking system to not have a regulator looking over it and to not be safeguarding the the sanctity of the financial system. And that's what people don't understand. It's not just we're going to keep interest rates at 0% and conduct quantitative easing and blow up the balance sheet. There's a lot more to the Fed than that. And safeguarding the financial system it's a big role, and making sure our banks are sound is important.
We could have a very long discussion about that, but we don't have time for that. Let's get back to interest rates. My own supposition has been that one of the reasons why they might allow interest rates to increase is so that they have some arrows in the quiver if they have to decrease them again. Is that a reasonable response, or am I missing a whole bunch of stuff?
I think that is reasonable. And now I'm going to wax optimistically. When Jay Powell was a rookie, when he was first on the Federal Reserve Board back in 2012, he did not see why interest rates needed to be at the zero bound. He felt that introduced distortions. So I would go one step further and say, I hope that they can get the Fed funds rate up high enough so that even after they lower it, they might find a happy new floor at a place called 2%, and agree that there's so much bad investing that goes on when you do get to zero that maybe they should revisit what that floor should be.
Yeah, I got a question for you, Danielle. You mentioned the 2% target early on in this discussion, and I'm wondering that eventually is going to sound like a joke, like subprime is contained and inflation is transitory. I think at some point the 2% target, that's a phrase that we're never going to utter again. Do you agree? And if so, when do you think that will be? When do you think it will change to something like, well, we need at least 5% to keep the economy going?
No, you could never. I completely disagree. 100%. We are seeing disinflation occur so quickly right now with discretionary goods that we're going to have whiplash. We've seen we actually put a Z-score. We normalized the declines in month-over-month inflation in July, and they're historic in terms of how quickly they're coming down. Because, I mean, at last check, there's no new Congress until, you don't get any fiscal stimulus measures passed until maybe March or April. And that means that, and we're doing layoffs and we're in recession. So it's one thing to say, gee, this household's got to choose. I'll just use the biggest cliche. This household's got to trade away from steak and trade into ground beef. They've got to substitute because they can no longer afford to have a T-bone for dinner. Even special occasion on Friday night, fine. There's a difference between that and the household not having any income. And when you don't have any income, your buying decisions become very different. And that's why we're seeing historic declines in airfares, rental cars, hotels, used cars. It's because what people don't have to buy, the non-essentials, because they're getting eaten alive in terms of food inflation being the highest since 1979, which is not something the Fed can control. But because the price of essentials is so high, we are seeing disinflation occur at a very rapid pace on the discretionary side of the ledger.
Yeah, Danielle, if I could clarify. So obviously, if we go into a recession, you're going to see prices adjust to that. Obviously, if we have unemployment, you're going to see prices adjust to that. But are you saying that long run, we're going to go back to a long run 2% trend in inflation, meaning at some point we're going to have to go below 2% to get that average in because we're up almost double digits?
Well,
now, is that what you're saying?
I think if Jay Powell could take one thing back, it would be not necessarily the word transitory, but average. That was a mistake. That was a big mistake. And the Fed needs to work to get it below 2%, period.
Okay. And you think they're going to do that? They're not going to change something. They're not going to change how the CPI is calculated or change the target or somehow weasel out of this responsibility.
Conspiracy stuff. No, at least not Jay Powell. Remember, people have to remember Jay Powell's a Republican, and he's not, and he's a man of integrity. So even though he may turn tail and run, it's not going to be because he wants to massage the data. It's going to be because he breaks the credit markets. And he's faced with a choice. He's faced with no choice, because he can put the economy into recession, which it appears he's pretty good at doing. He can do that. And he can let one company after another go bankrupt. But he can't let a whole bunch at once go bankrupt and have systemic risk break out that bleeds into the financial system, which is what we saw when Lehman went down. And you woke up the next day and you said, oh my God, a money market fund broke the buck. I didn't see that coming. And that's what systemic risk is. If he unleashes systemic risk, there's nothing he can do. He has to stop tightening.
So one might argue, though, to get a handle on the inflation, that might be necessary. That if the bubble gets big enough, the credit bubble, that something like that might be necessary to actually rein it in. What do you think about that?
Well, okay, so we rein it in, and then we have a global depression, because that's what happens when the global financial system goes boom.
Right.
And I don't want to see that. Nobody wants to see that. What we want for him to accomplish is to allow, I wrote about this a few days ago. We want for him to succeed in a controlled demolition. We want for him to put the 20% of all American companies that are zombies, to finally let them die, bury them and put them away. If he can thread that needle, and don't get me wrong, it's not going to be pretty. I'm not saying people are going to walk away with all their money. If we're in recession, as long as there's not a systemic event in the credit markets, you can see the stock market come way down. The reason the stock market's rallied as much as it has is because it's operating under the assumption that Jay Powell's finished, that he's thrown white flagged it. And you listen to the dovish Fed officials saying, we're going to keep hiking into 2023. And the market keeps saying, they're kidding.
So we got the credit analyst and speculator here. Rick, what the consequences of having what Danielle said, credit meltdown, I guess something big, but also the consequences of not popping this bubble properly and allowing it to come back too soon.
I believe that humans and institutions are fallible, and I believe ultimately the markets are bigger than institutions. I may be proven to be wrong. Albert, as you know, I have absolutely correctly forecast 17 of the last 3 declines. As a credit analyst, I'm always terrified of this stuff. I think part of it gets down in the near term to politics. And I'm curious what Daniela would say to the sense that part of politics is an ongoing war between spenders and savers. That spenders are benefited by negative real interest rates and savers are not. Spenders are numerous and savers are scarce. As I understand Danielle's former statement, that the way that we get back to positive real interest rates, if we ever do, is by controlling the denominator, which is to say, reduce the inflation rate below 2%. I'm interested in the politics of negative real interest rates or positive real interest rates. Obviously, as an example, if the U.S. 10-year Treasury reverted to mean, which is to say had a positive real yield, the 10-year would have to have a 10 handle on it. And a 10 handle would have interesting consequences for debt service at every level of society. So am I correct in saying that you would see the Fed orchestrating a return to positive real interest rates as a consequence of reducing inflation? Or do you think that the probability of positive real interest rates, which is to say benefiting savers at the expense of savers at the expense of spenders, pardon me, is something that's a political non-starter?
I think it's politically difficult to forge the path that you describe. I also think that it depends on which interest rate you're talking about. It's becoming more apparent that he's going to at least get to 3.5%, maybe 4% on the Fed funds, which means if you're a saver,
right,
and you get inflation back towards that level, which means that if you're a saver, you actually start to get paid.
Right.
In such an environment, I have to be careful to point out that the inversion of the yield curve would be much, much, much deeper.
Right.
That's why we have the 2s, 10s remaining inverted at the deepest level since the year 2000. And that's because the bond market is saying you're going to break something. We're in recession, but you're going to break something if we keep and it's steepened out a bit because we've seen inflation come down. Again, there is this presumption that Powell's finished. If we had 0 month-over-month prints in the CPI for the rest of the year, you'd still have something with 5 or 6% in front of it. Jay Powell's not finished until he breaks something, because 5 or 6% is nowhere near 2. It's not as bad as 9. We can accept that. But unless something breaks in credit, he keeps going in my mind.
So then, am I correct, and disabuse me if I'm wrong, by the way, am I correct in saying that you believe that part of the mandate of the Fed is to restore positive real interest rates? And do you think that that's politically feasible, irrespective of the number it settles out at?
Oh, I think that, yes, it is the Fed's duty to normalize interest rates, to normalize monetary policy, things that they have failed to do since Greenspan stepped into office on the coattails of Paul Volcker, who did the hard work. And that's the last time you had somebody actually making monetary policy correctly.
Do we describe normalization as a situation where savers could expect a real yield? Or do we describe normalization as a circumstance that allows a few politicians to stay in power? I'm interested in the real world implications of the policy discussions that you're having. I don't care myself if the inflation rate is 1.5% and the interest rate paid, as an example, on the U.S. 10-year Treasury is 2.25. What I'm interested in is whether real returns to savers are, in the view of yourself and or the Fed, economically feasible. That has important implications for gold investors, and hence my attendees.
Well, I mean, I understand where you're coming from. And politically, when you look at the squandered opportunity that the United States has in the rearview mirror, it did not issue century bonds. It did not issue 50-year bonds when it had the opportunity as the risk-free asset on planet Earth to do so. And when you're talking about politically palatable, what you're trying to say, in my view at least, is what's going to happen if the U.S. government has to behave? What's going to happen if the U.S. government, because they squandered the opportunity to push out the maturity of treasuries, and they have to refinance all of these bills and short-term notes, if the Fed keeps going, that the interest expense of the country is going to preclude Congress from passing pork. And, you know, in my mind, at least, maybe we get a full-on washing out of the entire Congress, because it's really hard to satisfy special interests and the lobbyists who keep you in office if you can't spend money as a country. Right. So politically feasible, who knows? Again, we forget Paul Volcker had death threats constantly.
Right. Right.
His life was threatened because of what he did. And there were likely politicians who were hoping that somebody would succeed in taking Paul out. And now he's a national treasure. But there's a reason that it's so difficult now. And it started with Greenspan. And shame on him. Because the deeper in you got, one individual after another, the more difficult it's become to thereby extricate yourself without blowing up the world. And even if they were to blow up the world, gold shines brightest. Because you can either have normalization and positive real interest rates, go gold, or you can have the Federal Reserve blow up the financial system, and then gold is even hotter. in terms of being a resource, because it's the only place to get diversification when a daisy chain of contagion sets off within the financial system and nothing is safe except for cash and gold.
Danielle, can I ask you a question? And this question is in the context of not you being an ex-Federal Reserve researcher, but you being an American and you having children. Would you rather they have this day of reckoning early, or would you have preferred that they seize that opportunity to issue 50, 100-year bonds and kick the can down the road?
Whatever is going to happen, I wish would happen now. I want it to happen when, I mean, my oldest is about to be a freshman in college. I want for this entire thing to blow up before they enter the workforce.
Me too.
I mean, that's just me being selfish mom. Now, they might
blow up before I have to pay for college.
If the world blows up, then they can go to community college and get, that's where I started. No harm, no foul, no shame. But no, I certainly want this to happen sooner rather than later. And again, people don't appreciate the gravity of the moment that we're at. Investors have been trained to believe that whoever's running the Fed is going to bend and pivot, whoever it is. They have been, this is a pure brainwash. I mean, this is truly, even companies, even corporations who are doing share buybacks right now, who know their companies are not doing well, who know that the economy around the world is in recession, and they're still buying back their shares because they have faith in the Federal Reserve. It's not just individual investors or institutional investors or retail, even the corporations who know that their businesses are suffering. They're firing people and still buying back their shares based on the assumption that the Fed's got my back. It is so ingrained. If Powell can break this mindset, that means he breaks the put. And that means that that's good for my kids. But it's going to be him who does it, or we're going to blow up an even bigger bubble and kick the can, which is very hard to do, I would add, without fiscal. Because in 2008, 2009, it was possible for the Fed to go at it alone. In the pandemic, you had to have trillions and trillions and trillions of dollars of fiscal stimulus in addition to the Fed put kicking in which they monetized every penny of it. I would argue that as long as the House swings Republican, it's going to be really difficult to repeat what happened in March 2020 unless they all sense that the world is ending.
I want to ask Rick about the state of these balance sheets, because companies did take the opportunity to cash up during the pandemic when the Federal Reserve was accommodating. Now, as Danielle mentions, we do have share buybacks. Is this responsible return of capital? And I know I'm generalizing, but you just pick any example you want. But is this responsible return of shareholder money, or is this irresponsible, and is it compromising the integrity of the balance sheet?
I think it really depends on who and why. You have, as an example, oil and gas companies now that could reinvest their free cash flows at very high margins. But they look at a circumstance where the political reality is that while Biden is on the one hand asking them to increase production, he's also saying he's going to put them out of business in 2030. From the point of view of those companies, if you have extraordinary returns on capital employed, if you're Exxon, you do both. If you're not Exxon, you return capital to shareholders because it's their capital, because as a consequence of the political reality, you don't have the ability to reinvest. You have to return the capital to keep it safe. In the case of other companies, I think there's perverse incentives. There are executives whose compensation is so closely tied to share price performance relative to other forms of corporate valuation that they're incented to cannibalize the company. And I think you are seeing way too much cannibalization. I would echo what Daniela said, that there is a pervasive belief in the Fed put. There is a pervasive belief that daddy in the form of Powell is going to kiss it and make it better if they fall off the bike. And I think that Fed put is, while perhaps not as pernicious as negative real interest rates, I think it's very, very pernicious.
Danielle, when you refer to the buybacks, are there any particular sectors you're thinking of? Is there anything egregious going on in your mind?
Well, I mean, apologies, but why do I have to buy a new one of these every few years? Because they can't make a battery that lasts. And they're the biggest share buyback company on planet Earth. Could they just invest a few pennies and figure out how to make my damn battery last? And I'd even pay extra. I would, if they were going to say, look, the gig is up. There's a few lawsuits out there, by the way. So the gig is up. We know that we create crappy batteries so that you're forced to buy a new phone just out of sheer disgust once every few. My husband, he had the damn thing upside down, twisted in order to get like a charge into it. I mean, he milked that thing until the transmission fell out of it, for God's sake, to use a metaphor. There are things that companies can do. There's investing that companies can do in the future, and damn it, they need to do it.
Danielle, you're not going to win. You're not going to win that battle. Even if you get the battery, they'll have an update that will render your phone obsolete. But Rick, let's talk about the mega caps company. I know you're going to say I don't know anything about that, but these things are just gushing cash, right? So appropriate probably for them to be returning it.
Again, I think it depends on who.
Yeah, I think in the cannabis industry, to Rick's point, give it all back. This is what I
mean. It's very tax efficient.
Excuse me.
It's very tax efficient to buy back shares. When I, as an individual, not in a tax advantage account, when I, as an individual, buy shares and I get paid a dividend, I pay tax on income that the company's paid tax on. To the extent that a company can return capital to shareholders if they're taxable by way of buybacks rather than dividends, it's always preferable because there's less tax leakage. What I object to, and what I think Danielle is objecting to, is the fact that companies are using artificially low interest rates to substitute debt for equity on their balance sheet, assuming that the market will never reassert control of interest rates, and that Chairman Powell will kiss them and make them better if they fall off the fiscal bike. And I think that's very risky. I, in my youth, substituted debt for equity on my own balance sheet. I remember it very well. And in 1981, it did not have a happy ending for me. And while I accept the fact that these CEOs are a lot smarter than me, I don't think that a lot of them are smart enough to run the balance sheets that they're running.
Right. Guys, I'd like to keep going with this discussion, but we have to get back to the program. So Danielle, thank you very much for joining us impromptu like this. Loved your talk. Loved doing the inflation panel with you. It was so much fun. And thank you for joining us here today.
Great to be here. Thank you. Thanks. And great event. Can't wait for next year.
All right. Thank you so much.
Thank you.
All right. So with this, I think we'll return back to the virtual floor.
Okay.
And maybe take a short break.
But time for a bio break.
Yeah. And then continue our discussions with the good folks in there. So thank you very much. And we'll see you down on the floor.